Mr. Government's need is to use the taxes paid by the public at large to monitor economic cycles. The tax rates are key levers that the government plays with at various economic cycles to maneuver this policy measure. Does the government have any idea of the relationships between tax rates it manipulates versus the tax revenues it gets? Laffer curve gives insight into this. Let's delve deeper. Let me ask you one simple question. If marginal, that is income tax rates are reduced, will income tax revenues increase or decrease? Most people think the answer is obvious. Lower tax rates mean lower tax revenues, isn't it? Let's understand it more. A typical tax equation could be tax revenues is equal to tax base into average tax rate. This says that as the tax rates increase, the tax revenues would also increase and vice versa. And that if tax base increases for a given tax rate, the tax revenues also increases. This assumes that the tax base is independent of tax rate. That is, any change in tax rate does not change the tax base at all. Now, let's assume an extreme situation. Let's say the tax rate is 100%. That is, all the money earned by the economy is fully taxed and goes into government coffers. In this extreme situation, would anyone have any interest in working? No, right? Because all his earnings coming out of work are going back to the government and he has nothing left. So he might as well not work at all. So obviously, whether tax revenues increase or decrease as the average tax rate is lowered depends on whether the tax base expands by a greater or lesser percentage than the percentage reduction in the tax rate. Let's take an example. A tax rate of 20% multiplied by a tax base of $1,000 billion generates $200 billion of tax revenues. Let's assume that as the tax rate is reduced, the tax base expands. The rationale is that individuals work more, invest more, enter into more trades, and shelter less income from taxes at lower tax rates. However, the real question is, how much does the tax base expand following the tax rate reduction? Suppose the tax rate is reduced to 15%. In case 1, the reduction increases the tax base to $1,200 billion. A 25% decrease in the tax rate, that is, from 20 to 15%, causes a 20% increase in the tax base, that is, from $1,000 billion to $1,200 billion. Tax revenues dropped to $180 billion. In case 2, the tax base expands by 50% to $1,500 billion. Because the tax base increases by a greater percentage than the percentage decrease in the tax rate, tax revenues increase to $22.5 billion. So, any change in tax rate has a direct impact on the tax base, and consequently, the impact on the tax revenues is derived from the multiplication of the two variables. Economist Arthur Laffer was a key economist who derived the tax rate and tax base relationship in detail. Laffer's objective was to explain the possible relationships between tax rates and tax revenues. In the exhibit, tax revenues are on the vertical axis and tax rates are on the horizontal axis. Laffer made 3 major points about the curve. At points where tax rates 0% and 100%, the tax revenue would be nil. Obviously, no tax revenues will be raised if the tax rate is 0. And if the tax rate is 100%, no one will work and earn income because the entire amount would be taxed away. An increase in tax rates from 0 to an optimal rate could cause tax revenues to increase. For example, an increase in tax rates from X% to Y% will increase tax revenues from TX to TY. Beyond the optimal rate, an increase in tax rate would decrease the tax revenues. Said another way, A decrease in tax rates could cause tax revenues to increase if the tax rate is above the optimal rate. For example, a decrease in tax rates from Z% to Y% will increase tax revenues from TZ to TY. This was the point that brought public attention to the Laffer curve.